Hi, this is AK Asnani from Smart VRC Bhopal. And today's topic is don't get misguided by the results. In the month of April, I have shown you this kind of timeline and how the COVID is progressing from around the world. And we discussed about the prospects of the various sectors. And subsequently, almost all the companies have declared their fourth quarter results and also the annual results for 2019 and 20. And based on the results, many of the stocks have reacted. But investors should be very careful while analyzing the last quarter results because in different states, the period of the lockdown has been different for different states and hence for the different companies. And also, it depends on the sector. If it is an engineering company, then last 10 days means a very big chunk of sales they have missed and also the collection of payments. So the impact of last 10 days on an engineering firm or on a capital goods firm is way higher than the FMCG company or for that matter, automobiles. And also in many parts of the country, still the lockdown is there and companies are not able to open their plants or work at full capacity. So comparing results has hardly any meaning. Moreover, the impact of COVID on various sectors will be different. So don't go by the results merely by the results, but also by the prospects of those sectors in the coming times. Presently, there is a pent-up demand, and so companies are able to operate at reasonably good capacity. But once this pent-up demand is over, then it all depends how the COVID progresses, and that will have an impact on the company's performance for the current year. So the Q4 1920 is almost over. Most of the companies have already declared the results, and the impact was only for the last 10 or 15 days of the year. But we can see a very big impact on the profitability. But at the same time, of the 365 days, it was only the last 10 or 15 days which has impacted the results, and still the results are below the market expectations. Now, coming to the first quarter of current year, is 2021. As we all know, in the month of April, there was total lockdown, and even for the month of May, for most of the companies, the plants were closed. So already for the current year, 2 months of production has gone. So, and many of the leading financial institutions, they have projected that Indian economy may contract, and up to 5% also projections have come. So there is the scenario. In the going for the second quarter, the things may improve much more compared to the first quarter as far as the total quarter is concerned. And the rest depends for the third quarter. It depends how the solution comes for COVID, tackling the COVID issue. To give you a glimpse, there is a notice from, or rather I should say the information from JK Paper on 12th of May 2020. It is to inform that the JK Paper Limited has temporarily suspended operations at its manufacturing facility, Unit CPM at Fort Songar, Gujarat yesterday for about a week due to lower market demand and extended lockdown in Western region. So, hope you have heard highlighted text is due to the lower market demand, and that was a month back in the month of May, 12th of May. Now, there is a statement from Executive Director Bajaj Auto, Mr. Rakesh Sharma, and these are edited excerpts. We expect that June should be almost back to 80% of a normal June, with the second half of June at an almost 90% normal level. There is a large component of pent-up demand that is driving current sales. As we discussed, is the pent-up demand, and even in the month of June, the plants are operating at almost 80 to 90% capacity utilization. The average sales will be 80%. Okay, so April and May have almost washed out, and even for the month of June, it is the 80% of the normal level. There is a statement from Mr. Ashish Harshraj. He is the president of Federation of Automobile Dealers Association. The first 10 days of June witnessed extremely low demand despite most dealerships open. And remember, in automobiles, there are lot many associated sectors which will have an impact. It is not only the auto ancillaries, but also the tires, the paint companies, the steel, plastic, cables, lot many other sectors will also bear the brunt of this slowdown. Now, there is a different sector, chemicals and companies, Atul Limited. Statement made on 28th May 2020. Demand in export market, except for supplies to customers belonging to aerospace industry, seems to be reasonable. It is too early to comment on the demand in domestic market as the business has just restarted. Okay, so for chemicals, at least in the export markets, demand is intact for Atul Limited. This is the statement made by Larsen and Toubro on 8th of June 2020. For the quarter ended 31st March 2020, the impact due to COVID-19 on the company's revenue and net profits were approximately 18 billion. 18 billion means 1,800 crores, and net profits impacted by 400 crores. The company resumed partial service of operations from April 14. 90% of the domestic project sites of the company are working with restricted labor capacity. The company is presently remobilizing the workmen, as a significant percentage of the migrant workmen have gone back to their villages. So there is another issue which is faced by the industry. So coming to the sector specific, banking and NBFC situation as compared to our previous presentation has not improved. Rather, it has deteriorated. My personal opinion, one should not have more than 10 to 12% exposure in banking and NBFC sector in your portfolio. Whitegoods this year has gone. Probably next year we can expect for good performance. Presently, the stocks are overvalued. In general, I'm talking about real estate. This sector, which was already passing through a great slowdown, will be highly impacted by COVID. Try to keep away from this sector also. Pharma, one of the few sectors which will have a minimal impact, and rather some of the companies may gain from COVID. But be selective. Most of the big companies are wanting high valuations, and we should be very selective. FMCG, companies are operating at 80 to 90% capacity utilization, and again, this being a consumption sector, performance may not be the same as in the previous year. There will be a decline of about 15%. Infrastructure, as we have seen the statement from Larsen and Toubro, so this will definitely have an impact, but a lot depends how the government announces the policies so as to give a boost the employment, and probably government will have to infuse a lot of money in this sector. Aviation tourism, better stay away from this sector. Hotels, yes, almost the same the case as for the aviation and tourism. Be very, very selective. Power, yes, improvement has happened during last 1 month, but still the demand is down by about 20 to 25%. Chemicals is the only sector which I believe will have a positive impact, especially those companies which are into the specialty chemicals and which have good exports. They will benefit also from the fall of rupee against US dollar to the extent of about 6 to 7%. And especially companies who have long-term contract with their customers will be able to pass through this phase successfully. Metals, better avoid. Healthcare includes, apart from pharma, it also includes the testing laboratories and hospitals. Definitely, this is the sector one can look for. Now, this is the result of the survey which I carried about a week ago, and this is an investor response of about 200 investors. How much fresh money you invested in stocks since 20th of March 2020? That means when the market was at a very low level. Since then, how much percentage of portfolio investors have invested? So this shows that about 18% investors have not made any fresh investment, and there are 22% investors who have invested more than 20% of portfolio size. This is pretty significant. And 35% of the chunk, they said that they invested 5 to 20%. And there were 25% investors who invested only 5% of portfolio size. Which sectors you preferred pre-COVID, that is before COVID? So 78%, rather 79% investors for finance, and another major was FMCG for 47%, then automobiles 39%, IT 5%. This is pre-COVID. And post-COVID, finance has reduced from 78% to 44%. Automobiles have reduced from 39% to 26%, and FMCG has increased to 55%. Pharmaceutical, which was earlier only 38%, has increased to 70%, the highest gainer, and we also expected the same. Chemicals, previously 36%, and now 59%. So these are the main highlights which investors think, what the retail investor thinks. Now let us compare this with the actual performance of the indices during the same period. During the same period, S&P BSC healthcare index is up by 20%, telecom is up by 18%, and rest all are in negative territory, including FMCG, technology, energy, oil and gas, and the hardest hit is realty. Right? Of course, FMCG, technology, and energy, they have lost less compared to the rest of the sectors. And what the most of the retail investors think is the same as indicated by the BSC indices. In terms of market cap, This blue colored chart is for pre-corona. Red colored bars, this is for post-corona, and yellow is the total change. So for BSC small cap, there is a net fall of 16%. Okay, and it fell by 36%. Pre-corona means about 18th of March, and post-corona it has increased by 30%, and the net change is minus 16%. And the story is same for even the large cap. Net change is minus 17%. Mid cap is 18%. The message is whether it is small cap or large cap or mid cap, all are performing almost in a similar fashion. There is no distinction. Now, there was one more query, one more question in the survey. Do you think stocks are underpriced post-COVID? And 52% said yes. The stocks are underpriced even today. And 31% they do not know. 17% said no. Stocks are not underpriced. And there was one more query, one more question. Have you postponed your investment in luxury items to invest in stocks? 75% of the investors say yes, they have postponed their investment in luxury items, and 25% said no. So most of the investors have postponed their investment, and of course, the question was regarding the luxury items. But we should understand that there is a large number of other sectors which are dependent on even the luxury items, and impact will be felt across the board. So if you are not ready to invest, if you are not ready to buy a car which you are almost ready to buy before COVID, then lot many other sectors will have to bear the impact. Similarly, same is the case for housing. Has your employer cut your monthly salary? 38% of the investors said yes, they have faced their salaries have been deducted, and the message is very loud and clear. If 38% of investors, their salary has been deducted, has been cut, so they are definitely not going, they are going to postpone most of their non-essential purchase, and even the remaining 62% for whom there is no salary cut, even they are also very watchful, very cautious. So overall, the investment mood in terms of the economy is not that good, but in terms of valuation, most of the investors think that the stocks are underpriced. This is a contrary. You must have heard a lot of times that we are going get ready for a new normal. Now, what is new normal? Now, there is a chart which has two data. One is this blue line, and this blue line stands for linear 6% growth. This is just an assumption. Okay, this is not an actual data. Just to make you clear, what do you mean by new normal? There is a 6% growth, and till 1890, everything was normal. That means about 15 months ago. Then in 1920, that is the year which has ended on 31st March 2020, there was a slowdown. So instead of 6% growth, we are going to have a growth of about 4%. So this, the line which was moving steadily upside, this will show a slight downturn. And assuming that our economy falls by 4%, when I say economy means the GDP, as most of the leading financial institutions, they are projecting. So the growth will fall from is about 117, almost 111. And thereafter, there will be a growth of, because now the base is low, there is likely growth of about 8 to 9% in the subsequent year. And afterwards, there is a 6% growth. So the new normal is this red line. As you can see, in 1920, that is, had there been no corona, then we would have been at 120. This is the economic growth. Then we would have been at 120. But because of COVID, we will again be at 120 only in 21-22. That means 2 years of delay. Now try to understand that. Theoretically, what does it mean? Just 3 months ago, whatever the valuations were there, if we assume that after 2 years the valuations are same, then it will take 2 years to restart the growth pattern. That means even after 2 years, the stock prices may remain the same. So I'm talking in terms of the index, not about the specific company stocks. So if we have to outperform the Sensex, if we want that, we should be able to log much higher returns than the new normal. Then we need to understand that we need to identify very specific stocks which will do well. Okay. Economy recovery will be V-shaped or U-shaped. So now that question has gone. Already a lot of damage has happened. Many people have lost the jobs, and there has been large number of pay cuts also. So question of V-shaped recovery is almost over. Now be ready for U-shape, and that too, this leg may not be as fast as was expected earlier. Regarding the strategy, as I said, review each stock and regularly, because with each day, the prospects are changing. We need to understand that which stocks will outperform. And last time I said that you divide your cash into 3 parts and invest a 1 part. And I don't think that the time has come to invest even the 2nd part. Maybe this is just my opinion. Stock market is filled with mad people. This is just, I have given you an example that it may take 2 years even to get back to the same levels as we were 2 months ago. But due to excess liquidity into the market, it's quite possible that stock markets may be at higher levels or maybe at much higher levels. This is just for the purpose of understanding. The best way to outperform is to be rational always. And this will help you in understanding the market. This will help you in not trying to predict the market, but always trying to concentrate on your portfolio. Your portfolio should be like that, should be built in a fashion that if the market falls, then it should have a minimal impact. And if the market rises, then your portfolio should outperform the market. Yes, for that you need to generate alpha, and there are not many stocks available in the market, especially in mid and small cap, which have the potential to outperform big indices. Thanks a lot. Do provide your feedback. Thanks.